The Silicon Valley Bank has just collapsed, and this makes it the biggest banking failure in the history of the United States and indeed that of the world since the financial crisis of 2008. This is a very significant moment, and a huge collapse such as this raises a lot of questions. So, here are a few questions that I'm going to find answers to in this video. First of all, what is Silicon Valley Bank? Secondly, why do we even care about this bank? Thirdly, what just happened to it? And that brings me to the fourth question, which is even more important. Why did this happen? Once we figured out the fundamental reasons behind why this collapse happened, we will look at the specific turn of events that led to this collapse. The next question that arises in our minds is what is going to happen next? And last but not the least, what are the lessons or learnings or implications out of this collapse that we can take forward? So, without further ado, let us dive straight into the discussion at hand. The first question is, what is SVB or Silicon Valley Bank? It's the 16th largest bank in the United States of America, which makes it a fairly large bank. If you look at the asset base, at its peak, it was well over $200 billion. So that's not a small amount by any shred of imagination. More importantly, the name of this bank gives you a clue as to its importance. This bank was a key player in the Silicon Valley or the startup or the tech ecosystem of the United States and indeed of many parts of the world. As per the website of Silicon Valley Bank itself, they counted about half of the entire industry, which is the startups that have been backed by venture capital as its own clients. And it wasn't just these companies or startups that were its clients or who were banking with them. They even had the venture capital funds opening their accounts with them. They also had the LPs or the limited partners, the guys who put money into the venture capital funds who were banking with these guys. So, in a nutshell, the entire startup ecosystem from the guys who put in the money to the venture capitalists to the founders to the startup and maybe even the employees, everybody was banking with Silicon Valley Bank. If you have anything to do with the tech startup ecosystem in the United States, you would know how pivotal Silicon Valley Bank has been over the last 40 years since its inception in 1983. So it's no marginal player, it's not come into existence of late. People outside this ecosystem may not have heard of this bank until recently when the news has come out. But there is a reason why, even if you had nothing to do with the US startup ecosystem, you need to be concerned and you need to care. Which brings us to the second point, who really should care about what happened to Silicon Valley Bank? The first and most obvious answer is that if you've got anything to do with the startup ecosystem anywhere in the world, in any capacity, you need to be aware of what is going on because there are likely to be ripple effects that we will face as a consequence of this massive collapse. Secondly, if you're connected in any way to the business world or the world of economics or finance, even if it is not in the tech sector, even if it is in any other sector, in any other geography, I think this event by itself is important enough for you to keep your eyes on it and at least understand what is going on. Thirdly, if you're not even connected to the business world or not interested in economics, if you've got money in your bank account, even if it is in savings account or fixed deposits with any bank anywhere in the world, you need to be concerned. And this pretty much makes it important for everybody in the world who's operating bank accounts to know why they should be concerned about what has gone on in Silicon Valley Bank because there may be some learnings from your perspective also. Now that we have some context in terms of what Silicon Valley Bank is and who should be concerned, let's try and understand what just happened to them before we understand why this happened in the first place. So now let us understand what exactly happened to Silicon Valley Bank. As you would be aware, in very simple terms, without getting into any of the technicalities, Silicon Valley Bank has become bankrupt. The operations have been stopped by the regulators, they've taken over control of the bank, trading of the shares of the Silicon Valley Bank have also been stopped. This has not happened all of a sudden. There have been a few run up events. So let's look at three things which have happened in the recent past. Without going too far back in time, the first thing that happened in this week in which they became bankrupt was the fact that they made an announcement that they have had to sell off billions of dollars of securities and taken a loss of about a couple of $1 billion on the sale of these securities. This led to a sequence of events where essentially two things happened. Firstly, the customers of the bank started taking their money out of the bank, and secondly, there was a run on the stock price of the bank, which tumbled by more than 60% in one single day. And the third big milestone was, of course, the declaration of the bankruptcy and the taking over of the control of the bank by the American regulators, in particular, the FDIC. As we try and understand why Silicon Valley Bank went bankrupt, we need to correlate the underlying reasons with each of the three things which happened in quick succession, leading to this collapse. The first element that was involved was the steady withdrawal of deposits by the customers of Silicon Valley Bank. The reasons for this are not very difficult to understand at all. If you've been following the developments in the tech and the startup ecosystem, you would know that this sector has been going through what is known as a funding freeze or the funding winter. Essentially, all it means that the inflows of capital into this sector in the form of venture capital funds or angel funds or any other funding for that matter have dried down or at least slowed considerably. Now, if you look at who are the customers of Silicon Valley Bank who've got their deposits with the bank, you would realize that they would be all people within the startup ecosystem. So they would be startup companies, tech companies, venture capital funds, LPs, ex promoters, everybody who's connected with the startup ecosystem. And when there is a funding freeze or a funding winter, everybody faces the paucity or the lack of funds. So, what has been happening over a period of time is that people have consistently been withdrawing their money from this bank. There is another reason why this has been happening, and that's the double edged sword of interest rates. If you look at the history of interest rates over the last few years, you will realize that the interest rates were very low, and over the period of the last year or so, the Federal Reserve or the Central Bank of the United States has raised the interest rate multiple number of times and it has increased drastically. What are the implications of this from the perspective of a customer? If you're a customer with a bank who's not giving you too much of interest and you know that in the economy the interest rates have increased, you would certainly want to take your money out and put it in higher interest bearing securities. So, from a startup perspective or from the perspective of any bank account holder of Silicon Valley Bank, there were two major factors. The first is the funding winter or the liquidity crunch, because of which they had to take out money. And secondly, the interest rate scenario, because of which it did not make sense to keep the money lying dormant in the Silicon Valley Bank account. This brings us to the third element of why this fiasco happened. Was it that Silicon Valley Bank, being such a large bank and well managed, did not even know how to manage the liquidity of their funds? The way a bank typically works in an oversimplified sort of way is that they have two sides of the balance sheet. On the one end, you have the deposits that the customer is placing with you, which is the liability side of the balance sheet. And the other side of the balance sheet represents largely two things. Firstly, the loans that you're giving to your customers, and secondly, the investments that you have in liquid assets, which are typically financial securities, bonds, etc., on which you get some return. One of the big concerns of the regulators of the banking system is that these customers who've put in their money into the bank, their money should be safeguarded and it should be managed well. If we take this entire pool of money and start giving it away as loans, and these loans, some of them do not come back, then the bank is obviously at a risk. So typically, what the banks do is that they park a specified amount of their capital into another asset class, which is these financial investments, security, government bills, treasury bills, etc. etc. So these are typically interest bearing securities which are not very risky as an asset class. Now let's come to Silicon Valley Bank. In the case of Silicon Valley Bank, on their books, they did have enough of assets to pay off the liabilities or pay off the depositors. But as I mentioned earlier, the interest rate was a double edged sword, and this changed the complete equation. And in order to understand this, we just need to understand the basic relationship between bond prices and interest rates. So, again, let me try and explain this to you in the simplest of terms possible. So, let's take a hypothetical example to understand this better. Let's say I issue you bonds and the prevailing interest rate is around 5%. So I issue you bonds of $100 at a 5% interest rate. Because the market interest rate is 5% and the bonds are also carrying a coupon or an interest rate of 5%, the price of the bond is $100 itself. Tomorrow what happens is that the interest rates increase. So if you were to invest those $100, somebody else is willing to give you 10% interest rate. Just to take a number, of course, interest rates do not move in such a jerky fashion, but this is an oversimplified example to help you understand the concept. Now, if I were to ask you, would you be willing to pay $100 to get only 5% interest rate? Your answer would obviously be no, and you would only be willing to pay me a much lower price for buying this bond of $100 because the interest rate in the market has shot up while I am only giving you 5%, the market is offering you 10%. As a result, as the interest rates rise, what happens to the bond price is that it falls. And as I mentioned to you earlier, over the course of the last year, the Federal Reserve has increased the rate multiple times and quite significantly and steeply. And now that you understand the fundamental relationship between bond prices and interest rates, you already know that if the interest rates would have risen, what would have happened to the bond prices? Of course, they would have taken a beating and they would have fallen. And that brings me to the next element, which is one of the core issues that led to the immediate crisis. And this was the nature of instruments in which Silicon Valley Bank had parked its funds. They did not park the funds in short term instruments, for example, the short term treasury bills issued by the governments. Instead of doing that, they parked the money in long term securities, which had many years to go for maturity. And this led to a mismatch because the depositors who would put their money into the accounts of Silicon Valley Bank were asking their money back, which essentially meant that this became a short term deposit, whereas the corresponding money that was parked in assets was parked in longer term maturities. Consequently, what they had to do was they had to sell off these assets and they had to honor the requests of the customers who were withdrawing the money out of the bank. And we already know that the prices of these securities, these instruments, had come down significantly. You can imagine what would have happened next. As a result of selling these securities at lower prices in the market, Silicon Valley Bank ran up huge losses to the tune of about a couple of $1 billion, which it announced earlier this week. In addition to this loss of around about a couple of $1 billion, the portfolio that the bank was holding, the value of that portfolio had also eroded because of a crash in the bond prices. The big moment and the turning point came when the bank made a public announcement earlier in the week in which it became bankrupt that they had suffered this huge loss on sale of the bonds. They tried to assure everybody that there was no reason to panic, but we all know how the human mind and how the human psychology works. If you go on the rooftop and shout that everything is okay, people instinctively know that everything is not okay. And there is some reason why you are coming and making that announcement and trying to soothe everybody's nerves. And this led to a chain reaction. As I described earlier, the customer base of Silicon Valley Bank was an extremely well connected network of people, whether it is LPs or venture capital firms or startup companies or ex promoters or angel investors. All of them were very tightly integrated in this entire startup network and startup ecosystem. And you can imagine that these limited partners or the investors and the venture capital funds, etc., they would be very savvy with their money. So they immediately sensed that something is wrong. And they started telling their entire network, their portfolio companies, the people that they were in touch with, that they should all start withdrawing the money from Silicon Valley Bank as soon as this announcement was made. And in very quick time, both of the two things that we saw started happening. First, an increase in the number of requests or withdrawals from the money in Silicon Valley Bank, leading to more losses, leading to more asset liability mismatches. And the second thing, of course, was a run on the stock price, which tumbled by as much as 60% in one day. And once all of this started happening, then obviously the regulators had to take note. And on Friday, 10th of March, they stepped in and declared the company bankrupt. They stopped the trading of the shares of the company, they declared it as bankrupt, and they took over the operations of the company. And I'm sure they'll come out with a via media to figure out what would be the next steps, how will the depositors get their money back, and what will happen to the ownership and to the operations of this bank. So I hope this has given you a very good understanding of what really happened behind the scenes. There may have been other aspects which may have contributed to these turn of events, and with these sort of fiascos or collapses, you never know what is lying hidden beneath the surface, and there may be more skeletons from the closet that may keep appearing from time to time. So, one of the other stories that is kind of intertwined with this story is the story of insider trading and the role of the management itself. As I understand, the CEO, the CFO, the chief marketing officer, all of them had sold a fairly large amount of their holdings in Silicon Valley Bank earlier during this quarter itself. So, what led to that? Were they aware of something that was cooking up? Is there something more that was being hidden? This itself raises a lot of questions. Were they aware of other things that were going on? Were disclosures made? Could they have done anything to prevent this? Could there have been more transparency up front? But let us not try and second guess what could have happened or some of the other things that are not corroborated by facts, because the sequence of events that I have narrated to you is based on the facts that are already available in the public domain. And the next big question is what happens next? Well, we don't know what is going to happen next, but one thing is very clear, that the FDIC, the guys who've taken over the control of the bank, are not going to have a lazy weekend. They'll probably be very busy trying to figure out how is it that they could make this work and ensure that the interests of the depositors or the people who have had their money in the Silicon Valley bank accounts are safeguarded to at least some extent. These deposits are insured only to the extent of about $250,000 in the United States by the FDIC. So, obviously, this means that if the bank has gone bankrupt and the value of the assets cannot be realized, there will be losses, and the insurance company will only be able to honor deposits of up to $250,000. And there are large companies who have had a much higher amount of money lying in Silicon Valley bank account at the time at which it went bankrupt. So, what happens to those losses will need to be seen. For instance, one of the large listed companies called Roku has already come up with an announcement saying that about 26% of its cash was lying in Silicon Valley bank account. And that's a fairly large number. Even though they are comfortable and they are saying that they have cash flows for the next 12 months, but it nevertheless is a big hit. And many more skeletons will certainly come out of the closet. And it may also lead to a chain of events or a domino effect. The other big implication of the bank going bankrupt is that people who had to pay salaries, process payroll, will be at a loss in terms of how they do it unless the FDIC is very quick in terms of coming up with a resolution. And if you're aware of the consumer spending and the consumer debt patterns in the United States, you know that lack of processing of the payroll on this bi monthly cycle or weekly cycle can lead to disastrous consequences and a ripple effect right through the economy. Even though the number of people directly impacted may be fairly small, but the overall impact on the economy can be huge. So these are some of the issues that will need a resolution. Of course, from an investor standpoint, people who invested in these stocks, they would be interested in knowing what is happening to SVB. Is it an investment which has come down to zero, or is somebody else going to buy this bank? Will there be some scheme of merger or amalgamation put in place so that at least they can salvage the value of their assets, or will the assets be stripped off and sold in a piecemeal manner and some value may be realized for the shareholders of Silicon Valley Bank? These are things we don't know. And of course, as they say, this is a developing story. But hopefully, so far you've got a good context of why you should care. What is Silicon Valley Bank? What happened to it? Why did it happen? What were some of the underlying factors that led to its collapse? And how did it all pan out? As you can imagine, there are a lot of learnings that can be drawn from this episode from multiple perspectives. That will be a fairly detailed exercise. As they say, failure is our best teacher. And in this case, such a massive failure has certainly got to be a very good teacher. The only thing is that are you willing to learn from this failure? And what I've done is made it extremely easy for you to cull out the learnings from this saga, irrespective of which stakeholder you are in this ecosystem. Even if you are holding a bank account with any bank, then there are learnings for you as well, because your deposits with the bank need to be assured. How do you ensure that your money is lying safe with the most trusted of banks? And of course, there are lessons for startup founders, for venture capitalists, for people who are in the banking space, and for anybody else who's a stock market investor. So, if you learned something from this episode of what happened to Silicon Valley Bank and why, then make sure you subscribe to this channel, since I regularly keep posting videos on a wide variety of topics related to the world of business, startups, technology, careers, and most importantly, learnings and insights and how to think about these things so that we can learn and make ourselves better. The link to the related episodes is also provided in the comments and the description. So join me as we drill down into the learnings from this episode of the collapse of the Silicon Valley Bank.